And we're rolling. You may or may not be able to deduct your inventory immediately when you purchase it. We're going to dive into all of that in this video and maybe in more detail than you prefer, but this is something that I get tons of questions about, and I want to have something that even my most detail-oriented clients will find helpful. Following tax-related inventory developments over the past few years has been an interesting ride. I've spent way more hours studying IRS regulations and guidance about inventory than I ever could have imagined. And in this video, I want to give you a brief overview of how things have evolved to give you better context for the situation and more confidence in how you ultimately decide to deduct your inventory. And stick with me until the end because I'll give you my assessment of the current landscape and what it means for how you should be tracking and deducting your inventory. Hey, my name is Mark too, and I'm a CPA and fellow reseller who specializes in helping resellers and online businesses with taxes and with growing their businesses profitably. I was on a roll with YouTube until this last tax season hit, and that threw me off for a while. But I'm back with this video on inventory, which I've been planning for months now. If you're a reseller, inventory is critical to your business, and how you deduct that inventory is critical to properly preparing and optimizing your tax return. The rules for inventory have changed over the years, so on top of general misinformation, there's also a lot of information that's just now obsolete and completely out of date. And I'm going to go through where we started and where we've ended up most recently. That way you'll have more context and be able to better judge what that means for your business. So first we need to back up a little bit and make sure you have a general understanding of cash versus accrual accounting. Don't run away. It's not that bad. The cash method simply refers to recognizing income or recording income on your books when cash is received, and recognizing expenses or recording expenses on your books when cash is paid. The accrual method is recognizing income when the work is done, even if you haven't been paid yet. For example, when you send an invoice after doing some work, you'll record income on your books, even though you haven't collected the cash yet. And recognizing expenses when they're incurred, even if you haven't paid for them yet. For example, receiving a bill and recording it in your books as an expense, even if you haven't paid for it. And we're still talking about the overall methods of accounting. We're not talking yet specifically about inventory. The IRS says that generally if you produce, purchase, or sell merchandise in your business, you must keep an inventory. Remember that phrase. And use an accrual method for purchases and sales of merchandise. This means that if you're an inventory-based business, you'd have to use the accrual method of accounting, not just for inventory, but for your overall method of accounting. But the IRS has an exemption for small business taxpayers. Before 2018, any inventory-based business with average gross receipts over $1 million was required to use the accrual method for tax purposes. But if you were below that threshold, you were generally allowed to use the cash method as your overall method of accounting. Regardless of whether you use the overall cash or accrual method, historically the required way to deduct your inventory on your taxes was still to deduct only the cost of your items that sold during the year. In other words, even if you used the overall cash method, you still had to use the accrual method for inventory. The inventory deduction on your taxes, and usually on your books, is called the cost of goods sold. It's sort of a unique deduction in that its name literally describes the timing of how to take the deduction. You would take the deduction when the inventory is sold. So let's say you purchase $10,000 of inventory during the year, but only $2,000 of it sells. Your inventory deduction is the cost of goods sold of $2,000. The remaining $8,000 of inventory stays on your books as an asset and will be deducted in the future year that it sells. Even if you use the overall cash method of accounting, which most small businesses do, it was still assumed that the inventory was treated using the accrual method, meaning that it was deducted when sold, rather than when it was purchased. Just look at how the federal income tax Schedule C is laid out. This is where your business activity goes if you're a sole proprietor or a single member LLC. You can select either cash or accrual for your overall accounting method, but regardless of what you select, the IRS has you list your beginning and ending inventory as a way to force you to use the accrual method for inventory and calculate a deduction for the cost of goods that sold. They have you back out your ending inventory cost balance as a way of preventing you from deducting inventory that hasn't yet sold. Now, technically, this is a hybrid method because you're using the overall cash method and the accrual method for inventory, but most CPAs will just mark the cash box since the accrual method for inventory is just built into the form. When I started working with resellers around 2015, many of them believed that if they were under $1 million, that meant that they could use the cash method for inventory as well. And that's because of language in the law that allowed you to treat your inventory as non-incidental materials and supplies. And I'm not going to get into what that means. I have an article in the link link below where you can read more about it. At the end of the day, it still left you having to deduct your inventory when sold and not when purchased. And I don't think it's relevant to most resellers. I spent the next few years encouraging resellers to deduct inventory only when sold and trying to clarify the myth of cash basis inventory. But then in late 2017, the Tax Cuts and Jobs Act was passed. This law introduced language that motivated some brave CPAs to start preaching that you could now deduct inventory immediately when purchased. No longer would you have to wait until it's sold in order to take the deduction. So using the prior example, you'd be able to deduct the full $10,000 of purchased inventory immediately in the year of purchase on your taxes. The Tax Cuts and Jobs Act increased the overall cash method exception from $1 million to $25 million. So if you were a small business taxpayer with average gross receipts of less than $25 million, then you now have the option of using the overall cash method of accounting. And it's higher than $25 million now because it's been indexed for inflation. And here's the part of the law that applies to inventory. The Tax Cuts and Jobs Act said that if you are a small business taxpayer, you can adopt or change your method of accounting to account for inventories in the same manner as materials and supplies that are non-incidental. Remember, this doesn't do us any good. Or two, that conform to your treatment of inventories in an applicable financial statement. Most of us don't have an applicable financial statement, so this won't apply to most of us either. Or three, if the taxpayer does not have an applicable financial statement, the method of accounting used in the taxpayer's books and records prepared in accordance with the taxpayer's accounting procedures. This last one is the key. It seemed to imply that if you use the cash method for your inventory on your books, then you could also treat it the same way on your tax return. When this went into effect in 2018, I approached it cautiously because it raised so many questions. I work with hundreds of resellers every year at tax time, many of whom are beginners, and some of them don't really have much in terms of books and records. Some of the accounting procedures I saw simply involved scrambling at the end of the year trying to go back and add up all the business expenses. So this inventory language in the law left many CPAs and professionals asking a lot of questions and making assumptions about what it meant for their clients. What did books and records actually mean? What if the client's accounting procedures were totally haphazard or inaccurate? Does that mean they could use that treatment on their tax return too? I spent a lot of time trying to educate myself and others on how resellers and small business owners should be deducting inventory. And where I settled was if the client wasn't keeping close track of inventory, or if they weren't listing it as an asset on their books, if they had books at all, or if they were using the cash method for inventory on their books by deducting inventory purchases immediately, then I was okay with them using the cash method for inventory. In other words, deducting inventory purchases immediately. Because the law says that you can use the same inventory treatment on your taxes as the method of accounting used in the taxpayer's books and records. And I even confirmed this over the phone with an IRS tax attorney. This is an attractive method if you prefer simplicity. It requires less work and less time to track. It might be a good fit for someone who enjoys reselling on the side, maybe isn't planning on trying to scale significantly, and plans to keep things pretty steady. But for someone who plans to grow, hire workers, and have the tools to analyze their profitability, I still recommend the traditional accrual inventory method way of tracking inventory. It does require a bit more work, but I think it's worth it. There's so much insight to be gained by using this method because it matches up the inventory deduction with the sale that it belongs to. So then you can see your true gross profit. And here's what I mean. Let's say in year one, I had sales of $50,000 and I purchased $60,000 worth of inventory. In year two, I had $50,000 of sales again, and I didn't purchase any inventory. Using the cash method for inventory, I had a gross profit or loss in year one, in this case, of negative $10,000, so a loss of $10,000. And in year two, I had a pure gross profit of $50,000. My cost of the inventory I sold isn't being deducted against the sales that they're generating in year two, so the books look a little wonky. Using the traditional method, the inventory accrual method, you would deduct only the cost of the inventory sold. So let's say you sold half the inventory in year one and half in year two. You would deduct the first half against the sales they generated in year one and the same in year two. And to me, this presents a much clearer picture of what's going on in the business, and that's going to allow you to make better decisions to drive your business forward. Anyway, for the tax years 2018 through 2020, I've allowed my clients to use the inventory cash method if they really wanted to, but I let them know that there was still some ambiguity around the law. Fast forward to January of 2021, and the IRS finally came out with much awaited guidance for a whole host of questions people were asking about the original 2017 laws. Initially, to me, it looked like the IRS might be shutting down the inventory party we'd been enjoying for the past 3 years. But after further research, it seems to me that there are circumstances that will likely apply to many of you in which you will still qualify to use or continue to use the cash method for inventory. If you really want to knock yourself out, you can read the guidance for yourself in the links below, but there are really only a few sections that I think are key to what we're talking about. Again, this might be too much detail for some of you, but I really want to provide the information here because it's so hard to find comprehensible translations out there. The new January 2021 guidance gave us further direction about the instances in which a small business taxpayer could deviate from the traditional accounting method of inventory. Again, those instances introduced by the Tax Cuts and Jobs Act of 2017 included classifying your inventory as non-incidental materials and supplies, which we don't care about, accounting for your inventory on your tax return in the same way as you treat it on your applicable financial statement, which we also don't care about because it doesn't apply to most of us, or using the method of accounting used in the taxpayer's books and records prepared in accordance with the taxpayer's accounting procedures. This is the category we care about. What the guidance did was tell us what qualified as your books and records prepared in accordance with the taxpayer's accounting procedures. The IRS confirmed books and records to mean the totality of the taxpayer's documents and electronically stored data. Before this guidance, many believed that if a taxpayer business owner's accounting procedures included immediately deducting inventory on the business books, that's all you needed to do to qualify for using the cash method for inventory on your taxes. And that's essentially what the tax attorney I talked to at the IRS at the time told me. He said that until the IRS came out with more guidance, you pretty much had to draw your own interpretation. But in the new guidance, the IRS is saying that if you account for your inventory in a certain way on any of your books or records, not just your bookkeeping books or financial statements, that might count as keeping an inventory, and therefore you'd have to show an inventory on your taxes, basically meaning that you'd have to use the traditional accrual method for inventory. So I was starting to think, darn, it seems like in that case, pretty much all resellers will be disqualified from using the cash method for inventory because most of us do have some type of records that have information about our inventory, whether it's the actual active inventory listings we posted online, a spreadsheet we use to keep track of our inventory count records, and so on. Here's what I've concluded. In some of the examples they give in the new guidance, they talk about doing physical inventory counts and how that might impact whether or not you're considered to be keeping an inventory. Just counting your inventory quantities for storage or reordering purposes does not appear to disqualify from using the cash method, but allocating costs to the inventory or valuing the inventory or making representations about the cost of the inventory on hand all signify to the IRS that you're keeping an inventory and therefore is part of the accounting used in your books and records and therefore must be taken into consideration on your tax return, meaning that you need to use the accrual method for inventory or deduct it when sold. So even if in your official bookkeeping you deduct your inventory when purchased, the fact that you have other records where you show your inventory costs qualifies as keeping an inventory and supersedes what you're doing on your bookkeeping and requires you to use the accrual method for inventory on your taxes. So this is the bottom line. And again, this is my interpretation after dozens of hours of researching this stuff. If you aren't valuing your inventory, or in other words, if you aren't determining the ending inventory cost balance and it isn't reflected in your books and records, then it appears that you can use or continue to use the inventory cash method, which means deducting your inventory when you purchase it rather than when you sell it. But if you are keeping track of your overall inventory balance, meaning the total cost of everything you have on hand, or making representations about it, then you'll need to use the inventory accrual method, meaning that you'll deduct your inventory when sold. Wow. Did you make it this far? If so, congratulations. You may need to watch it again. I promise not all my videos are this deep. I just wanted to put out there what I've found in case it can help others. Check out my Reseller Tax Academy in the links below. I'm also putting together a beginner's bookkeeping course for resellers, so be watching for that. And also check out Not Your Dad's CPA on Instagram for more tips and behind the scenes to help you optimize your tax situation and overcome the anxiety so you can focus on building your business profitably.